10 things you should know about the differences between IFRS and GAAP accounting. We'll dive into the fascinating world of accounting as we explore the 10 essential things you need to know about the differences between International Financial Reporting Standards, IFRS, and generally accepted accounting principles, GAAP. Whether you're a student, an accounting professional, or simply curious about the complexities of financial reporting, join us as we uncover the nuances and key distinctions between these two widely adopted accounting frameworks. Get ready to expand your knowledge and gain a deeper understanding of the intricacies that shape the global financial landscape. Let's dive in. Number 10. Global versus U.S. focus. International Financial Reporting Standards, IFRS, is a set of accounting standards used globally, while generally accepted accounting principles, GAAP, is specific to the United States. IFRS serves as the preferred accounting framework for many countries worldwide, including major economies such as the European Union, Canada, and Australia. Its global adoption promotes consistency and facilitates international financial communication and comparability among companies. Number 9. Principles versus rules-based approach. IFRS is categorized by a principles-based approach to financial reporting. It provides overarching principles and objectives, allowing companies to exercise judgment in applying them to their specific circumstances. In contrast, GAAP follows a more rules-based approach with detailed regulations and specific guidelines for various accounting transactions. GAP's emphasis on explicit rules aims to provide clear and specific guidance, ensuring consistency and standardization in U.S. financial reporting. Number 8. Standard setting bodies. IFRS is issued by the International Accounting Standards Board, the IASB, an independent global standard setting body. The IASB works to develop and refine IFRS based on input from various stakeholders worldwide. In contrast, GAAP is determined by multiple standard setting bodies, primarily the Financial Accounting Standards Board, the FASB, in the United States. The FASB is responsible for setting accounting standards applicable to U.S. companies, while considering input from stakeholders and conducting extensive due process procedures. Number 7. Reporting format. Both IFRS and GAAP follow a similar reporting format, presenting financial statements that provide essential information about a company's financial position and performance. However, they differ in terminology. IFRS refers to the statement of financial position, statement of comprehensive income, and statement of changes in equity. GAAP, on the other hand, uses the terms balance sheet, income statement, and statement of shareholders' equity, respectively, to refer to these same financial statements. Number 6. Valuation of inventory. Under IFRS, inventory can be valued using the first in, first out, FIFO, or weighted average cost methods. GAAP allows for the use of FIFO, last in, first out, LIFO, or weighted average cost methods, but LIFO is most commonly used in the United States. The choice of inventory valuation method can significantly impact a company's reported financial results and the cost of goods sold. Number 5. Treatment of research and development costs. IFRS and GAAP differ in their treatment of research and development (R&D) costs. IFRS allows for the capitalization of certain research costs under specific conditions, considering the potential future economic benefits. GAAP, on the other hand, generally requires the immediate expensing of all research and development costs as they are incurred. This distinction in accounting treatment can affect the financial statements and profitability of companies engaged in significant R&D activities. Number 4. Fair value measurement. Fair value measurement involves estimating the current market value of assets and liabilities. IFRS places more emphasis on fair value measurement, requiring companies to measure certain assets and liabilities at fair value. GAAP allows for more flexibility in using historical cost, fair value, or other measurement bases, depending on the specific circumstances. The differential emphasis on fair value measurement can result in variations in reported values and recognition of gains or losses in financial statements. Number 3. Leasing Standards. In recent years, IFRS and GAAP have converged in their treatment of leases. Both now require lessees to recognize lease assets and liabilities on their balance sheets, with certain differences in details and disclosures. The convergence aims to improve transparency and provide users of financial statements with a more comprehensive view of a company's leasing agreements and associated financial obligations. Number 2. Revenue recognition. Both IRF and GAAP have converged on the core principles for revenue recognition. IFRS 15, revenue from contracts with customers, and ASC Topic 606, revenue from contracts with customers, provides a unified framework for recognizing revenue. However, some differences in specific guidance and industry-specific considerations still exist, leading to variations in how companies report revenue under IFRS and GAAP. One extra bonus thing you should know about the differences between IFRS and GAAP accounting before we get to number 1, the differences between IFRS and GAAP accounting standards can significantly impact a company's financial statements. Varying rules and principles related to revenue recognition, asset valuation, and expense treatment can lead to differences in reported financial results, ratios, and key performance indicators. Companies operating in multiple jurisdictions or considering cross-border transactions need to carefully analyze and understand the potential impact of adopting different accounting standards on their financial statements, as it can affect investor perception, credit ratings, and compliance with regulatory requirements. Number 1, disclosure requirements. IFRS and GAAP have different approaches to disclosure requirements. IFRS generally has more principle-based disclosure requirements, focusing on providing relevant and meaningful information to users of financial statements. GAAP, in contrast, tends to have more detailed and specific disclosure requirements, covering various industries and transactions. The different approaches to disclosure aim to provide stakeholders with the necessary information to make informed decisions while balancing the need for transparency and practicality. Understanding the differences between IFRS and GAAP accounting is crucial for multinational companies, investors, and financial professionals operating in various jurisdictions. It ensures accurate financial reporting, facilitates comparison between companies following different accounting standards, and enables effective decision-making in the global business environment. These have been 10 things you should know about the differences between IFRS and GAAP accounting. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more financial education videos, and share your thoughts in the comments below. Thanks for learning about these differences with me, and have a great day.